Thank you so much. Yeah. Okay, we are ready to start with our next speaker. If I can please ask everyone to take their seats. We are ready to start. Ladies and gents, please, we are ready to start. Thank you. I think I'll just wait for the gentlemen who are topping up the water to finish, just to avoid any feedback. And then we shall start. Please, can I ask that we settle down? We are ready to begin. Thank you. Thank you, everybody. Is it still morning? Good morning. For those of you who are coming to this session for the first time, my name is Isabella Mnisi, and I have been chairing this session since this morning. So for our next session, it's going to be a solo presentation on innovative financing structures to financial institutions in Africa. And our speaker is Mr. Edmund Higenbottam. He is the Managing Director of Vedant Capital and has been focused on high development impact sectors in Africa for the last 10 years. And he raised the $100 million Vedant Capital Hybrid Fund, and which is a fund investing in tech-enabled SME lenders. Prior to Vedant Capital, Edmund worked in London and in emerging markets at bulge bracket investment banks, including Morgan Stanley and Deutsche Bank, and he has over 20 years of experience in the financial services sector. Let's welcome on stage Edmund. And of course, if you have time left, we will be happy to take a couple of questions. Thank you so much. I don't know if you will be presenting. Here's the...
Well, thank you very much for the kind introduction. Talking about funding for micro, small and medium-sized enterprises and the extent to which these funding solutions can be generated from the banking sector or whether it should be from specialized institutions, which we call inclusive financial institutions or IFIs. Do we see this sector as being well catered for by traditional banks, or do we need IFIs to fill the gap? And if so, what should those IFIs be doing? And what should we as the investment community be doing to support them as part of our work? So maybe just setting the scene for a moment, if you look at the GDP of the African continent, it's a little bit less than $3 trillion. If you look at emerging markets, mature emerging markets, the first world, private sector credit to the real economy or to the private sector is about 100% of GDP. If we look at Africa, it's about 30% of GDP. So that means the banking sector is providing private credit or credit to the private sector about $800 billion So, put it slightly differently, if the banking sector was providing as much credit, as much loans to the real economy as it should, or other parts of the world are doing, then we'd have an extra 1.6 trillion of private credit to the real economy. Or put that differently, that's loans to individuals, be that mortgages or car loans. And that's loans, which is what we're focused on, loans to micro-entrepreneurs and loans to SMEs. So we think the bulk of that credit gap is those segments which are very poorly covered. And why does that matter? Well, we see micro-entrepreneurs and SMEs as the engine of growth in the African economy. We don't see the public sector as growing. We don't see the resources sector, oils and mining, while that can contribute towards GDP, we see that as having a limited impact on domestic employment and domestic livelihoods. So we see micro-entrepreneurs and we see SMEs as critical in driving the development agenda. What we've seen in the last 10 years, the last 15 years, is very significant changes in technology in the financial sector. So we've seen, and I call that the ecosystem, I call that the rails. So mobile wallets, mobile money, how data is aggregated, how data is handled and analyzed. And that's the ecosystem on which creates a very significant opportunity to intermediate for lenders on the ground to create loans to small businesses, to micro-entrepreneurs, to other types of small borrowers. And that opportunity realistically didn't exist 15 years ago. So what we see as an opportunity for the best financial companies, the best credit businesses, the best microfinance businesses, the best IFIs, to use those rails, use that ecosystem to close at least part of that credit gap. And that's what we call the IFIs. So what's absolutely striking is there is a chasm in terms of performance between the top quartile and the bottom quartile. And these numbers are slightly misleading because it is looking at the COVID period. And what we see, leaving aside the COVID period, we see the top IFIs doing a return on equity of 30 to 40%. We see the bottom quartile of IFIs doing a return on equity that's negative. They're making losses. There's a big difference in financial performance. Why is that important? Well, if this sector is to grow, if this sector is to extend more credit to the real economy, to micro-entrepreneurs, SMEs, these businesses need to be profitable in their own right. They need to be profitable so that they can grow. And that's one of the key challenges for us as the investor community to sift out between the bottom quartile, the third quartile, the second quartile, and the top quartile. Microfinance is not a term that people use very much, or it's a term that's a little bit going out of fashion in terms of financial community. A lot of challenges in terms of traditional microfinance. These are businesses who are providing capital to micro-entrepreneurs, SMEs in the continent, but perhaps using more traditional types of funding methodology. A lot of these businesses are characterized by expensive processes, whether that's cash handling. Cash handling is very, very expensive, or paper-based systems, or they've got expensive branch infrastructure, which is neither convenient nor efficient, convenient for the customer or efficient. So what we've seen over the last 5 to 7 years is a community of successful businesses which have really built up or grown up on those rails, or on that new tech ecosystem which has evolved over the last 15 years. And these companies are leveraging that technology to do business differently and more profitably and more successfully. And we call these businesses the digital natives. So getting cash out of the loan cycle. So you don't extend credit in a loan. In cash, you extend credit with mobile money or mobile payment. Remember, most of these customers don't have bank accounts. You have a life cycle of your loan that's 100% digital. There's no paper-based application. And ultimately, you use data to credit score. So you have a credit scoring system where you have pass or fail, but it's a score system. You can change your underwriting criteria, change the minimum score to originate a new loan or size as the market goes up and down. So maybe we're going to touch on a few specific examples. Closed loop working capital financing. So this is how we describe lenders who've got control over one end or other of the working capital cycle, and they use that to originate credit in a risk-adjusted way. They use that to have some control over their borrowers, and they use that to aggregate data regarding their prospective borrowers. So great examples of that would be someone like a Retail Capital in South Africa, which was bought by Time Bank, and Us Plus in South Africa, someone like a Flow in Uganda, which is doing financing to small merchants, or somebody like a 4G Capital in Kenya. And we see these businesses 100% digital. So loans made by mobile money, straight to the mobile wallet, repayments directly from the same place. The whole credit cycle is digital, so no paper. And much stronger credit scoring, and in many places risk-based pricing. Another segment we like is asset financing backed by tracking technologies. So financing assets which small business people and micro entrepreneurs need for their careers. So if they're a taxi driver, if it's in East Africa, they can get a bottle loan. If they're in Southern Africa, they can get a taxi loan to buy a minibus taxi, and they can make a living every day. And this is backed by technology, so the vehicles can't disappear. And if you don't pay your loan on time, you get a knock on your door and somebody's telling you to take your bike back, which you don't want. And again, using very similar complementary systems. Everything's done. There's no cash. You get physical possession of the vehicle. It's not you don't get a loan, which you can use. You can use that loan as a micro entrepreneur for something that you're not telling your friendly MFI why you're using it. But the asset is dispersed. And again, it's using the risk-based pricing. One of the questions we often get when we look at winners versus losers is, are you better off being a digital native business which was started or built on that new ecosystem, on those new rails, which has a lot of advantages because you don't have legacy infrastructure, you don't have legacy costs? Or are you better being an established, regulated business that can take deposits and then try and transform your business model by getting rid of the paper, getting rid of expensive assets, and digitalizing your business? So there's clearly pros and cons and advantages each way, but predominantly we see the digital native businesses being more represented in the top quartile of performers than what we call the transformers. The transformers is what we call the more traditional businesses who are changing their business model. Is consolidation a driver of performance for the IFI sector, for the microfinance sector? So we definitely think that consolidation has a role to play in increasing the overall financial performance of microfinance under IFIs. We think that is important. One case study I would quickly give on that is the contrast between India on one hand and Africa on the other. So population of India and Africa is the same. The aggregate GDP of the whole of Africa is about the same as India. But if you look at Africa, we've got 54 countries. If we look at India, we've got one country. So much easier for financial companies, in fact any companies, much easier for financial companies to access capital, grow, because you're never crossing national borders. So yes, within Africa, we have lots of clients, lots of partners who have successfully expanded from one country to the next. They've replicated their infrastructure, their compliance, got new licenses and gone into a new country. But clearly that's much harder than if there aren't borders. And one sort of snapshot of what I mean by harder is, if you look at the last 10 years, there's been $5 billion in the IPO market raised by IFIs in India, 10 times as much as in Africa. So consolidation in country versus cross-border, we believe there's a lot of synergies and advantages to both, but there's more advantages obviously in country. Great example in country, retail capital being acquired by Time Bank. Cross-border, our firm advised Lesotho, or advised AFB on their sale to Lesotho in Ghana. So, yes, definitely more synergies in country, but there's only so many good businesses in your own country, so cross-border M&A has a role to play as well. Fintech boom, is the fintech boom over? Well, I guess short answer is no. Headline from PitchBook last week, Africa's fintech market defies the VC downturn. So our sense on this is yes, venture investing in Africa, yes, fintech investing in Africa is weaker than last year, but it's proven a lot more resilient than the rest of the world. And that's largely because of fundamental reasons. Our financial sector in Africa is much more needed disruption than the financial sector in Western Europe and the UK and the US, where the services are much better. Very quickly in our fund, $100 million final close fund, we're investing hybrid equity and subordinated debt into tech-enabled, best-in-class microfinance MSME lenders. We're not investing in startups or fintechs, but we are investing in those businesses who've proven their business model, proven their credit portfolios, but really focus on those who have that knock-on impact through making loans to micro-entrepreneurs and to SMEs, and really looking to build a more vibrant, dynamic African economy through that transition mechanism. I don't know if anybody has any questions. A gentleman at the back.
Sorry.
Yes.
All right.
Hi, thank you very much for the presentation. I think it gives a good overview of what is going on. I think one of the things that most of the international funders would like to understand are what are the appropriate instruments to invest in financial inclusion in Africa. And right now, that's the question that we're facing, because, of course, on the debt side, it's getting very, very challenging for cross-border investment on the debt side. So if you look at financial institutions in Africa, what type of instruments do you think will actually aid them from the international perspective? Thanks.
Thank you, Stanley. I think as a whole, the market is short equity and equity-like instruments. And I think that's a challenge as a community as to how do we set up structures which can be a conduit for equity or hybrid equity type capital to get into MFIs. I think that does make it easier from managing a lot of risks, whether that's capitalization risk, balance sheet risk, whether that's managing FX risk. And ultimately, if we look at Verdant Capital's 10-year history working in microfinance, inclusive finance, what we see is the amount of leverage in the sector going up every year. We see the microfinance banks and the credit businesses getting more and more leveraged every year. And that's a good thing. It means they're making more loans to micro-entrepreneurs and SMEs. But what it also means is the amount of equity in those businesses hasn't kept up. And our fund is looking to, in its own small way, to contribute towards greater capitalization of the microfinance banks and IFIs. Hello.
Can you hear me?
Yes, I can. I'm just trying to move backwards to that slide, but it won't.
Okay.
There we go.
Yes, for the rest of the audience, my question was around the financing tracking technologies. So you use the example of car assets or motorbikes, something like that. And I'm particularly interested in agricultural lending and tracking of equipment, mechanization, and whether that's an area of growth or have there been challenges around tracking in other examples that you've seen?
So maybe just mention your name and your institution.
I'm sorry, my name is Alexandra Spieldak, and I'm with Bounty Field International, which specializes in post-harvest technology solutions for smallholder markets.
Thank you very much for the question. So we see that tracked asset finance as being an attractive conduit to get credit to the agricultural sector. We think it's probably the easiest way of getting credit to the agricultural sector. It's not dependent on necessarily the traditional seasonal cycle, how well your crops grow, being able to repay security on that working capital. Is not dependent on land, and land can be very difficult to get title deeds over, particularly in rural parts of the continent. So it is the cleanest way of getting funding to the agri sector. If we look at the businesses which I'm aware of who do equipment financing through a similar methodology to these players, to the agri sector, they are smaller. And the reason they're smaller is they've got a smaller addressable market than I think they've got a small addressable market, but you might query that because the agricultural sector is very significant. But these business models have been successful because they've standardized their product, and that's enabled them to grow scale at an affordable price. And the challenge for the agri equipment financiers is to build similar scale and then get similar access to capital. And query why that's not been possible. Is there fewer opportunities to create credit? Does one need to look at sharing of equipment between different farmers, which adds to different layers of complexity? Do we need to look at a different business model? Would it be easier if we could set up a business in 5 different countries at the same time without having 5 different licenses? Coming back to the point, the contrast of India. I'm sorry, I don't think I've answered the question very well, but it's a very interesting question. A gentleman at the back. Okay, thank you very much.
Opilo from Botswana, Tikano Group. Yeah, so I think one of the things that we have observed is that a lot of the funds don't have appetite for companies in Africa who don't have much equity, because they always want to do equity-linked investments. Yeah. So you'll find that there are lots of people who worked in the banks. I'll talk about myself, worked for FNB, Standard Chartered Bank, and Stanbic Bank. So all those are big portfolios that I held. But then when you try to raise capital, you always don't get through the line because of the balance sheet issue. But I believe that if you can look into the strength of the transaction, the strength of the management, the risk mitigants that the companies put in place, not necessarily the balance sheet, that will be a transformative approach to Africa. That's why now you'll see a lot of people empowering others because of that strength and the strength of the structuring. Thank you.
I 100% agree with the premise behind your question. A lot of senior lenders in the wholesale market funding financial businesses such as yours, it's very much rules-based. And then you've got a rule for NPLs, you've got a rule for minimum capital, you've got a rule for balance sheet size. You kind of tick all those boxes, then 99% you're going to get the loan. You've been operating 3 years, there's another rule. So you tick those rules. And what we've seen over the last 5 years is very interesting, is the emergence of new funds which aren't handcuffed to those specific rules. And they have more discretion, more flexibility. They can do bigger loans versus the amount of equity capital. And I think that's very, very important. We'd like to think that Verdant Capital Hybrid Fund is one of those. Investors have more flexibility and have a more fundamental approach than a rules-based approach. And, but I would say it's probably 10% of the investment community, maybe fractionally less. Thank you very much indeed for being our MC. Thank you very much indeed.
Thanks a lot, Edmund, for a very interactive and interesting conversation. I think this is the end of the morning session of the investing, and I will then, this is the end of my chairing role. I think I will then hand over to the next chair. I'm not sure if the next chair is here or if there's a break in between. I think there's a tea break. Yeah, there's a tea break or comfort break. For now, we'll see you guys later. Thank you.